In this video, I'll be talking about owner's draw and distributions. So let's get started. Now, first of all, we're going to be looking at an owner's draw. So the first thing that we're going to look at is what does it even mean? So, what is it? So, an owner's draw is when the business owner takes money directly out of the business for personal use. Now, we're going to look at key features. Key features. So the first one that we have is business structures. Now it's commonly used in sole traders, partnerships, and LLCs. And now for the tax implications, I'm just gonna go ahead and write it down. Tax implication. So it's not a taxable event on its own since the owner's profits are taxed on their personal return and the business's total profits are reported as income whether or not they're drawn. Now we're gonna look at advantages. Advantages. So it's flexible as owners can withdraw money as needed, and it's simple because no special distributions or formal process like a payroll is required. Now we're gonna look at the disadvantages. Disadvantages. So it can lead to financial strain on the business if not managed carefully, and it requires diligent tracking to ensure proper tax reporting. Now that is it for an owner's draw. Now we're going to look at what's a distribution. Now a distribution is a payment of the business's profits to its owners or shareholders. Now as for the key features, the business structure. It's typically used in partnerships and LLCs and corporations. And shareholders or owners receive distributions based on ownership percentages. So let's say you have three owners, one with 50% and the other two with 25%. Then out of the profits, the one with the 50% is going to receive 50% profit. Now, as for the tax implications for a sole trader, partnership, or LLC, distributions are passed through income taxed on the owner's personal return, similar to owner's draw. For S corporation, distributions are not subject to self-employment or payroll taxes, and for C corporations, the distributions or dividends may be subject to double taxation, tax at the corporate level and again at the individual level. As for the advantages, it's more structured. Distributions follow ownership percentages or shareholder agreements. And it's more tax efficient for S Corps since distributions aren't subject to payroll taxes. Now for the disadvantages, it is less flexible as you must adhere to the business's profit sharing rules. And it requires careful planning and accounting to comply with tax and corporate rules. So that is basically it for owner's draw and distributions, and I hope that this video has helped you out, and I'll be seeing you guys next time. Peace out.